Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm your host, David Robson. If you're a founder, early employee, or angel investor, and you've heard whispers that some people sell their startup stock and pay zero federal tax, you're not dreaming. You're probably hearing about qualified small business stock, or QSBS, under Section 1202. Today's episode is your practical playbook: how to qualify, how to document, how to keep that status intact, and how to exit without tipping the IRS more than necessary. We'll cover what counts and what kills it: C-corp status, the $50 million gross assets test, the 5-year holding period, original issuance, the 80% active business test, and the hidden traps like redemptions and early secondaries. We'll dig into stacking strategies using trusts, spouses, and partnerships, 1045 rollovers to save eligibility if you get a pre-5-year offer, and the messy realities of safes and convertibles. I'll also tell you exactly when to bring in a seasoned tax planner, ideally sooner than later, because timing and documentation are everything with 1202. Quick disclaimer, this is education, not legal or tax advice. Your facts matter. You'll want a professional who lives and breathes this. Now, let's unlock some tax smarts. Why does QSBS matter so much? In one sentence, potential 0% federal tax on a huge chunk of your gain. If your stock qualifies and you hold it more than 5 years, Section 1202 lets you exclude from federal income tax the greater of 10 million or 10 times your basis per taxpayer, per issuer. For stock acquired after September 27, 2010, the exclusion is generally 100%, and the excluded gain isn't subject to the 3.8% net investment income tax. It also avoids the old alternative minimum tax preference that plagued earlier 50% and 75% exclusions. That's why founders and angels get giddy about it. When it works, it really works. A quick illustration. Suppose you're a founder who acquired stock at a nominal basis and sell after 5 years for $20 million. If you meet QSBS rules and have the $10 million cap available, you can potentially exclude $10 million of gain entirely. If you planned ahead and used stacking strategies to create multiple taxpayers, more on that later, you could lawfully shield more than $10 million. On the other hand, an early angel invests $1 million and sells for $15 million. 10x basis gives a $10 million exclusion, and the remaining $4 million gain after basis may be taxed normally. That 10x basis prong can be more generous than the flat $10 million. The punchline: if you're building, funding, or joining a high-growth company, QSBS is one of the few truly transformative planning opportunities in the tax code. But it's fragile. You have to set it up right, monitor, and exit thoughtfully. Let's define what actually qualifies as QSBS. First, the issuing company must be a domestic C corporation. S corporations and LLCs don't issue QSBS. If you're operating as an LLC or S-corp today, we'll talk later about converting, but stock only counts from the point you're a C-corp. Second, you must acquire the stock at original issuance. That means from the company directly, through formation, purchase in a primary round, option exercise, restricted stock issuance, or conversion of a convertible note or SAFE into new shares. Buying shares from another shareholder in a secondary sale won't qualify, even if the seller's shares were QSBS in their hands. Third, the $50 million gross assets test. The issuing C-corp's aggregate gross assets must not exceed $50 million at all times before and immediately after the stock is issued. This test is measured using the adjusted basis of assets with special rules. Cash is counted at face value. Property contributed to the corporation is treated as having a basis equal to its fair market value for this test. If the company later raises money and grows past $50 million, previously issued stock that qualified stays qualified, but new shares issued after crossing the threshold won't be QSBS. Fourth, the 80% active business test. During substantially all of your holding period, at least 80% of the company's assets by value must be used in the active conduct of a qualified trade or business. That excludes businesses in health, law, engineering or architecture, accounting, consulting, financial services or brokerage, banking, insurance, financing, leasing, farming, mining or extraction, and hospitality like hotels and restaurants. If your startup is building software, medical devices, distinct from practicing medicine, clean tech hardware, manufacturing, or most tech-enabled services, you're typically in the clear. But facts matter. Consultancies that do more client services than product can drift into a disqualified category. Finally, the 5-year holding period. We'll dive into when that clock starts depending on how you got your shares. But put those 5 elements together: domestic C-corp, original issuance, under 50 million at issuance, 80% active business, and 5-year hold, and you've got the blueprint. Let's unpack the 5-year holding period and the clock. This is where many otherwise eligible taxpayers get tripped up. Founder stock. If you receive founder shares at formation or via a subsequent original issuance, your holding period begins on the date the stock is issued to you. If the stock is subject to vesting and you make a timely 83B election, your holding period starts at the grant date. If you don't file an 83B, your holding period for QSBS purposes generally doesn't start until the shares vest. That difference can be the difference between hitting the 5-year mark or missing it by months. Options. For incentive stock options, ISOs, and non-qualified stock options, NSOs, the holding period starts when you exercise and acquire the stock, not on grant. If you believe the company will be QSBS eligible, there's a real incentive to exercise early, ideally when the fair market value is low, so your 5-year clock starts sooner. Early exercise with an 83B election can be a powerful tool. Restricted stock units, RSUs. RSUs are generally settled in stock upon vesting. The holding period usually starts at settlement because that's when you receive actual shares. There's no 83B for RSUs. Safes and convertible notes. The holding period typically starts when the instrument converts into stock at a qualified financing or other trigger. The safe itself is in stock. That's a key reason we coordinate conversion timing. If a conversion happens after the company's assets have blown past $50 million, you may have missed QSBS for those new shares. Mergers and reorganizations. In certain tax-free reorganizations, you can exchange QSBS for stock of another corporation and tack your holding period. There are limits, especially if you receive cash or other property, boot. We'll touch on this in the exit planning section. A quick planning checkpoint. If you're within striking distance of the 5-year mark and the company is considering a sale, timing can be everything. Sometimes a few months' patience equals millions in tax savings. That's when you want your planner at the table, closely modeling scenarios. Anti-churning and redemption traps are QSBS kryptonite. Congress didn't want companies gaming the system by issuing stock and immediately buying back other stock, so Section 1202 has 2 separate redemption tests that can taint QSBS. Significant redemptions. If the company purchases more than a de minimis amount of its own stock during a 2-year period centered on your issuance, generally the 1 year before to 1 year after window, and those repurchases exceed a threshold percentage of the company's outstanding value, new stock issued in that period can be disqualified as QSBS for all taxpayers. The threshold is typically 5% of the aggregate value of the company's stock, but apply the specifics carefully with counsel. Related party redemptions. Separately, if the company redeems stock from you or a related person during a broader window spanning roughly 2 years before to 2 years after your issuance, your new stock may be tainted. That means tender offers and company-facilitated liquidity around fundraisers can inadvertently nuke QSBS for the very shares people are most excited about. Practical steps. Build an internal redemptions radar. Before any buyback, tender offer, or company-facilitated secondary, someone should be evaluating the 1202 impact. If you're about to issue new shares in a financing, coordinate timing so repurchases are outside the sensitive windows when possible. And track repurchases meticulously. I've seen QSBS turn on whether a tender closed a few weeks before or after new shares were issued. Now the $50 million gross assets test in practice. For QSBS, aggregate gross assets are generally measured by the adjusted basis of the corporation's assets. Cash counts at face value. Property contributed to the corporation is treated as having a basis equal to fair market value for the purpose of this test, so you can't stuff low basis assets and sneak under $50 million. What does immediately after issuance mean? It's a snapshot at the time your stock is issued. If the company had $30 million of assets and you raise a $25 million round, you need to measure before and immediately after the issuance. If the post-issuance gross assets exceed $50 million, those newly issued shares are not QSBS. Shares issued just prior, while the company was under $50 million, can qualify. Tracking adds up quickly as companies scale. Keep a running schedule that records each issuance date, total asset basis just before and just after, and documents contributions of property and cash. When you acquire companies or spin up subsidiaries, update the schedule. I've seen diligence go sideways because no one could prove the $50 million test at old issuance dates. A simple monthly or quarterly memo with supporting financials can save a deal. One nuance: exceeding $50 million after your share issuance does not strip QSBS status from already qualified shares. It only affects future issuances. Entrepreneurs sometimes worry that a big Series C ruined everything. It didn't. If your shares already qualified, they keep their status assuming other tests are met. How do you stay within the 80% active business test? This isn't a set it and forget it checkbox. The test asks whether, during substantially all of your holding period, at least 80% of the company's assets by value are used in the active conduct of a qualified trade or business. Cash can count as used in the business if it's working capital reasonably expected to be spent on operations or research and development within a reasonable period. Startups often raise cash that sits on the balance sheet. It's okay, within reason. But parking large amounts in long-term investment securities or drifting into an investment company profile is dangerous. There are also limits on holding too much stock or securities of other corporations unless there are more than 50% owned subsidiaries engaged in qualified activities. For subsidiaries you control, you generally look through to their assets and activities. A real-world rhythm. Each quarter, have finance run an 80% test check. How much of asset value is tied up in operational assets, cash for payroll and R&D, equipment, IP, receivables? How much is in passive investments? Document the rationale, especially for large cash balances, post-financing. If you pivot the business, revisit whether you remain in a qualified trade or business. For example, a software company becoming a consulting firm might blow the test. Keep this point in mind. You don't need to be perfect every day of every year. The statute speaks in terms of substantially all of the holding period, but the closer you are to the line, the more your documentation needs to be crisp. Founders, employees, and angels typically enter the QSBS world differently, so let's treat them separately. Founders. You usually receive stock at incorporation or in the early days at nominal cost. Your key actions: make timely 83B elections on restricted stock, track issuance dates carefully, and avoid redemptions around your issuance. If you're converting from an LLC or S-corp to a C-corp, remember that only stock issued after the C-corp conversion can be QSBS. That's a common tripwire. Employees. You're often granted options or RSUs. For options, consider early exercise if it's feasible and consistent with 409A and company policy. Early exercise with an 83B starts your 5-year clock. For RSUs, remember your clock starts on settlement. If liquidity is on the horizon, the difference between vesting in Q3 and a sale in Q2 next year could be a painful mismatch. And be careful with company-facilitated liquidity programs. Those are redemption-adjacent events that can taint other issuances. Angels and early investors. You must buy at original issuance, participate in priced rounds or safes, convertibles that convert into new shares. Secondary purchases don't qualify. If using a fund or partnership, you can pass QSBS status through to partners who were in the partnership when it acquired the stock. New partners who come in later generally don't get QSBS on existing holdings. If you're writing a small check and the company is close to the $50 million threshold, confirm the timing before wiring. Missing by a week is not uncommon, and it's heartbreaking when you realize it at exit. Let's talk stacking the exclusion. The $10 million or 10x basis cap is per taxpayer per issuer over your lifetime, reduced by prior excluded gains for that issuer. That means different taxpayers can each claim their own cap for the same company's stock. The temptation, of course, is to multiply taxpayers, spouses, and community property. For federal purposes, married filing jointly generally counts as one taxpayer for the cap. If each spouse independently owns separate QSBS, say they each acquired at original issuance through separate entities or employment, they may each have their own cap. In community property states, planning can be nuanced. Don't assume a simple gift the week before exit doubles your cap. It likely won't and may trigger assignment of income issues. Trusts. Non-grantor trusts are separate taxpayers and can have their own caps. Grantor trusts are not separate taxpayers. Gains flow to the grantor's cap. Families sometimes use multiple non-grantor trusts for different beneficiaries to multiply caps. The IRS and courts look for economic substance and bona fide arm's-length planning. Create real trusts with real purposes and meaningful independence well before an exit. If you do it on the eve of a sale, you're asking for an audit and an unpleasant letter. Partnerships and funds. QSBS can pass through. The key is that the partner must have been a partner when the partnership acquired the QSBS. It's not a Lego kit you can reassemble later to multiply caps after the fact. Also, limits are applied at the partner level. A stacking case study. 2 co-founders each hold QSBS. Years before exit, they each create 2 non-grantor trusts for distinct beneficiaries and gift portions of their QSBS into those trusts. Each taxpayer, the founder, and each of the 2 trusts may have a $10 million cap. That can multiply the exclusion meaningfully. Done sloppily or too late, this strategy can backfire. Done right, it's one of the most powerful planning tools in the startup landscape. Gifting and inheritance. The law is relatively friendly here, but the details matter. Gifts. If you gift QSBS, the donee steps into your shoes for QSBS purposes. The stock remains QSBS if it was QSBS in your hands, and the donee tax your holding period. For the 10x basis cap calculation, the donee generally uses your basis, not a new fair market value. Timing is critical. If there's a binding commitment to sell and you gift right before closing, the IRS may argue assignment of income and treat the gain as yours. To reduce that risk, make gifts well before term sheets are signed and certainly before there's a legally binding sale. Inheritance. If QSBS passes at death, the beneficiary also steps into the decedent's shoes for QSBS status and holding period, and the basis for the 10x cap is generally the decedent's basis for 1202 purposes, even though the beneficiary may get a step-up in basis for other tax purposes. The law prevents you from using a stepped-up basis to turbocharge the 10x cap. Practical tip. Coordinate gifts and trust planning with both your estate attorney and your QSBS tax advisor. The right sequence and documentation make all the difference. Section 1045 rollovers are the safety net when opportunity knocks too early. If you've held QSBS for more than 6 months but less than 5 years and you sell, you can elect to roll your gain into replacement QSBS within 60 days. The result? Your gain is deferred, your holding period taxed to the new stock, and you preserve the chance for a 1202 exclusion later. What counts as replacement QSBS? You must buy stock at original issuance of another domestic C-corp that itself would qualify as QSBS if you held it 5 years. The replacement company needs to meet the $50 million test at issuance and be in a qualified trade or business. You can allocate your sale proceeds among multiple replacement issuers. Execution matters. The 60-day window is tight. Deals often close on a Friday, and by the time you celebrate and catch up, the clock is half gone. You also must attach the appropriate statements to your tax return and keep meticulous records of the rollover. If you receive partial cash and partial stock, you may have some current gain and some deferred gain. And state conformity to 1045 varies. Model that. A quick example. An angel holds QSBS for 2.5 years and has an opportunity to sell for a 10x return. She wants the cash but hates losing QSBS. With a 1045 plan, she sells, reinvests the gain portion within 60 days into replacement QSBS across 2 promising C-corp and effectively keeps the QSBS dream alive. 3 years later, she exits both and claims the 1202 exclusion on the now 5+ year holding period. Converting entities, LLC or S-corp to C-corp. Many startups begin life as an LLC taxed as a partnership or as an S corporation. QSBS is available only for stock issued by a C corporation. That means the eligibility clock starts when you become a C corp and issue stock. Units or S corp shares held before conversion generally don't get QSBS treatment. When you convert, be mindful of the $50 million test. Property contributed to the C-corp is treated as having a basis equal to its fair market value for the gross assets test. If you've built valuable IP inside an LLC and then drop it into a C-corp with a big fair market value, you could blow the $50 million threshold on day one. Plan the timing and sequencing of financings and conversions so that founder and early employee shares qualify. Also, nail the original issuance point. Stock issued in the conversion is typically treated as issued by the C-corp, but you need a clean paper trail. Board approvals, stock certificates, capitalization tables reflecting the new C-corp shares. Don't assume a casual check-the-box election fixes everything. Work with counsel and a tax professional to structure the conversion correctly and confirm QSBS eligibility going forward. Exit planning is where all the good QSBS planning either pays off or gets thrown out the window. The golden rule: QSBS applies to gains from the sale or exchange of stock. If your exit is an asset sale, 1202 doesn't help the sellers. The corporation recognizes the gain, and then you deal with corporate-level tax and potential shareholder tax at distribution. Buyers often prefer asset deals. Sellers with QSBS prefer stock deals. Negotiate accordingly. Stock for stock deals. In certain tax-free reorganizations, if you exchange QSBS for stock of the acquirer, you can preserve QSBS status and tack your holding period to the acquirer's stock, up to your remaining 1202 cap. If you receive cash, boot, that portion is generally taxable and not eligible for exclusion. Earnouts and installments. If your stock sale includes an earnout paid in cash later, your eligibility for exclusion typically is determined as of the original sale. The portion that qualifies remains excludable when recognized. But documentation matters. Spell out that it's a continuation of the same stock sale. If your earnout is paid in stock of the acquirer, confirm whether that stock is eligible for tacking or whether you're outside 1202's reorg rules, Section 338 elections and deemed asset sales. If the buyer makes an election that treats the transaction as an asset sale for tax purposes, you may lose the ability to claim 1202 even though you technically sold stock. Negotiate the tax election terms with counsel. Practical tip: get your tax planner in the room before you sign the LOI. A sentence in a term sheet can swing your tax bill by 7 figures. Safes and convertibles deserve their own spotlight. The central QSBS questions are: when does the clock start? Does the conversion produce original issuance stock? And does the company meet the $50 million test at conversion? Clock start. For most safes and convertible notes, your holding period for QSBS starts on the conversion date. When you receive actual stock, the instrument itself isn't stock. That means a safe issued in year 1 but converted in year 3 starts the 5-year clock in year 3. If a sale occurs in year 7, you're good. If it happens in year 7 minus a month, you might miss by weeks. Original issuance. When the safe or note converts into newly issued shares from the company, that's original issuance. If it converts into shares purchased from existing shareholders, you're not at original issuance and you lose QSBS. $50 million test. Critically, the $50 million measurement happens at conversion. If the company exceeds $50 million in gross assets immediately after the conversion issuance, your new shares don't qualify even if the safe was signed when the company was tiny. Plan conversions alongside financing rounds to keep conversions under the threshold where possible. Redemption windows. Be careful with company buybacks in the 1 year before, 1 year after issuance window around a big conversion event. A tender offer concurrent with a conversion can taint the newly issued QSBS. Takeaway: safes are not QSBS poison, but they require deliberate choreography. State conformity is the great QSBS buzzkill. Federally, post-9/27 to 2010 QSBS can be 100% excluded from income and NIIT. States, however, vary widely. Some states largely conform to Section 1202 and allow the exclusion. Others don't conform at all and fully tax the gain. Some partially conform or have special rules. For example, in some jurisdictions, the state conforms, but a city tax does not. Historically, California has been a notable non-conformer, while New York State has had broader conformity, but New York City has not. Rules change, so you must check current law in your filing year. If you're stacking with multiple taxpayers across different states, or relocating before exit, model your state impact. I've seen founders move to a no-tax state well before exit and save millions. I've also seen folks move after the deal is effectively locked and end up with no state savings. timing and residency rules matter. Let's build your diligence-ready QSBS file. If you're within 12 to 24 months of potential exit, buyers and their tax counsel will ask for proof. Don't make them dig. What to include? Cap table history from formation to present, with evidence of original issuances and any splits. Stock certificates and issuance documents, including subscription agreements and board minutes. 83B. Elections and proof of timely filing for restricted stock and early exercises. Option grant and exercise files, including 409A valuations contemporaneous with grants and exercises. Safe and convertible note agreements and conversion documentation, including dates, share calculations, and whether shares were newly issued. Gross assets schedules at each relevant issuance date, including balance sheets, fixed asset registers, and support for fair market values of contributed property. Redemption logs and tender offer materials around financing windows to demonstrate compliance with anti-churning rules. Active business test support. Quarterly or annual memos showing at least 80% of assets by value used in qualified activities with working capital rationale for cash balances. Tax returns and financial statements for the relevant years. QSBS representation letters drafted with counsel to provide to buyers, often with officer certifications. Keep this in a single folder your counsel can share in the data room. A clean QSBS file can increase buyer confidence and sometimes your valuation. Let's run through a common pitfalls checklist. If any of these sound familiar, flag them now. Founder secondaries near financings. Company-facilitated sales close to new issuances can trigger the redemption taint. Tender offers or buybacks in the 1 year before, 1 year after issuance window. Coordinate timing carefully. Waiting too long to exercise options. If you exercise months before exit, you'll miss the 5-year clock. Consider early exercise strategies. Missing or late 83B, elections on restricted stock or early exercises. That can push your holding period start to vesting dates. Asset sales or deemed asset sales via tax elections that blow QSBS benefits for sellers. Drifting into disqualified activities, especially services businesses that gradually become consulting heavy. Converting safes or notes after the company crosses the $50 million threshold. Failing the active business test by parking too much cash in investments or accumulating passive assets without documentation. Sloppy records for gross assets at issuance. If you can't prove it, assume a buyer will be skeptical. Gifting QSBS too close to a binding sale, inviting assignment of income challenges. 1045 rollovers missed because the 60-day reinvestment clock wasn't tracked. Trusts created too late or without substance. The IRS is not impressed with last-minute window dressing. Fix what you can now. Many of these are timing and documentation problems that a proactive plan can cure. When should you engage a pro? My short answer: at formation, at financing, at equity events, before secondaries, and well before exit. At formation or conversion. If you're forming a new C-corp or converting from an LLC or S-corp, set the QSBS foundation correctly. Track gross assets and active business from day one. Before major financings, confirm you're under $50 million for upcoming issuances and that there are no nearby redemptions. Review safe and note conversion timing. When granting or settling equity, early exercise options where appropriate, file 83B and coordinate RSU settlements with potential exit timelines. Ahead of any secondary sale or tender, evaluate anti-churning exposure and structure liquidity programs safely. 6 to 12 months pre-exit. Build the QSBS file, model stock versus asset deal structures, and implement stacking or trust strategies with enough lead time to withstand scrutiny. At Premier Tax and Business Services, this is our wheelhouse. We model stacking strategies, evaluate trust structures with your estate counsel, vet redemptions and conversions, plan 1045 rollovers, and assemble diligence-ready QSBS documentation so buyers and their lawyers nod instead of frown. Even a 1-hour consult at the right moment can prevent a very expensive mistake. Let's close with a quick action plan you can put into motion this week. 1. Confirm C-corp status and eligibility. If you're not a C-corp and you want QSBS, map the conversion path now. If you are a C-corp, confirm you've been domestic from inception. 2. Implement a QSBS tracking policy. Assign an owner, often your controller or CFO, to maintain a living QSBS file with issuance dates, gross asset snapshots, 83Bs, option exercises, conversions, and redemption logs. 3. Monitor the 80% active business test. Do a quarterly check, especially after financings. Document why your cash is working capital. 4. Avoid disqualifying redemptions. Build a sign-off process so legal and finance consult tax before any buyback or tender offer, especially near financings. 5. Audit your equity. Identify who holds potentially eligible QSBS, founders, employees, angels, and where clocks started. Decide whether early exercises or 83B elections are worth pursuing going forward. 6. Evaluate stacking opportunities. If appropriate, design non-grantor trust structures or separate spousal ownership with real substance. Do it early. 7. Pre-wire a 1045 plan. If an early exit comes knocking, you'll be ready to reinvest within 60 days instead of scrambling. 8. Model state taxes. Confirm whether your state and local jurisdictions conform. Consider relocation timelines if they're part of your plan. 9. Schedule a QSBS consult. A targeted review can confirm what you have and what's at risk. QSBS is one of those areas where a bit of discipline yields outsized rewards. You don't need perfection, you need awareness, documentation, and timely decisions. That's a wrap for today's episode of Tax Smarts Unlocked. We covered the full QSBS playbook, why Section 1202 matters, and how it can deliver a 0% federal tax rate up to the greater of 10 million or 10x basis per issuer. What qualifies? Domestic C-corp, original issuance, the $50 million gross assets test, the 80% active business rule, and which industries are generally excluded. We walked through the 5-year holding period across founder stock, options, RSUs, and safes or convertibles, and we spotlighted the silent killers, redemptions and tender offers near financings. We got practical about the $50 million test, how to monitor the active business threshold, and how founders, employees, and angels should structure equity to maximize eligibility. We discussed stacking with spouses, trusts, and partnerships, plus the substance over form risks, and how gifts and inheritances can preserve QSBS and tax holding periods. We explored Section 1045 rollovers for early liquidity, entity conversions from LLC or S-corp to C-corp, exit structures that preserve QSBS, and how to handle earnouts and reorganizations. We highlighted the state conformity trap, the diligence-ready QSBS documentation buyers expect, and a checklist of common pitfalls. Finally, I gave you a 9-step action plan and clear timing cues for when to bring in a professional. Here's the value proposition in one line. With proactive planning and clean records, QSBS can turn rumor into real savings. If you're building or backing a high-growth company, get ahead of this now. If you want help modeling stacking strategies, vetting redemptions, coordinating safe conversions, planning a 1045, or preparing a bulletproof QSBS file, reach out to Premier Tax and Business Services. We do this every day, so you don't have to. If you found today helpful, subscribe, share it with a founder friend, and leave a review. I'm David Robson, and this has been Tax Smarts Unlocked, where smart planning beats surprise tax bills every time. See you next time.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.